Hello, everyone. Listen, I am so glad that you tuned in. I just heard about this. Now, I had heard some of what has been happening so far as the credit limits getting slashing, but I did not know that it was on this scale. Okay, so listen, do me a favor. Go ahead and like, share, subscribe so you can see more videos like this. I want to let you know that this may sound disheartening, but never fear, all right? Here at Velocity Consulting, we have all kinds of options that you can do to help you, your family, and your business out. Okay, so I'm going to get into this, and we want you to know that we have your back 100%, okay? So watch this. As this economic fallout, all right, of this current situation continues to unfold, these banks are rushing to close credit card accounts, you guys, or they're even slashing the credit limits to curb their risk. Now, 25% of Americans with the credit cards said that they had an active account involuntarily shut down from mid-May to mid-July, while 1 in 3 said their credit limit was reduced. Now, this is according to a new report from CompareCards.com, and they surveyed 1,003 credit card holders. Now, this follows a similar rate of reductions in April and comes as many Americans battle joblessness and uncertain economic futures, but now with reduced access to credit. Matt Schultz, he's actually the chief industry analyst at Compare Cards. As you can see, he's saying that these are really big numbers, and it means an awful lot of Americans had one of their financial security nets taken right out from under them in one of the most difficult economic times in American history, and it could be arguably compared to other humongous difficult times. Now, the pullback by these credit card issuers is occurring actually more frequently than in 2008 during the Great Recession. You remember that? When 1 in 6 credit card holders reported reduced limits or involuntary account closures. This is 1 in 5. Okay, so it is more. And this is actually according to a 2010 study by Phoenix Synergistics, a market research firm for financial services companies. Mr. Schultz goes on to say that this is in a lot of ways a much bigger issue today than it was in the Great Recession. It makes sense that these banks are taking an even harder line with lending because there's so much that they don't know and they're so nervous about. Now look at that word. You see that? They use that word, risk. Remember, banks have to be risk averse in order to make tons of money. All right. And so what it says here, 20% cardholders saw a credit decrease of at least $5,000. Now, while most credit limits were reduced by $1,000 or less, more than 1 in 5 cardholders said their limits were slashed by at least $5,000. Now, what does this mean? What this means is that the banks are hedging their bets. Okay, it's better for them to do this, the slashing of the $5,000, than it is to continue on with those credit card holders that aren't making their payments on time. Because remember, this is happening to people, to Americans making more than $100,000. Okay, they're the most likely to have their credit limit cut. And why would their credit limit get cut? Remember, this is happening only to people who are missing their payments, okay, and they haven't utilized their card. So it's not happening to people who are making their payments on time, right, who are doing the things that they need to do in order for their credit scores to go up. All right, let's go ahead and continue, and we'll come right back to that. Young millennials, as you can see, were the most likely to be affected among the generations. 4 in 9 young millennials currently between 24 and 31 had a card closed, while 5 in 9 had their credit limit reduced. And it says we know an awful lot of millennials got very enthusiastic about credit card rewards over the last few years, so they may have a few cards in their wallet that they haven't used in a while. And then it goes on to say a reduced credit limit likely will ding your credit score. Do you know why it would ding your credit score? That's because it increases your utilization rate. By lowering the amount of available credit that you have, the second most important factor in credit scoring, which of course the first most important factor is payment history. That's right. And so we want to come back to what we were saying here. It's saying that the young millennials currently between 24 and 31 had a card closed, while 5 and 9 had their credit limit reduced. Then it goes on to say Americans making more than 100,000 were the most likely to have their credit limit cut. So it's not saying that it's relegated to that certain class of people, but it is the most likely that they're going to have their credit limit cut down. And so we see these banks are hedging their bets. However, if you are making your payments early, and that's always what we push here at Velocity Consulting, to make your payments early, you would not have to be as concerned, okay, because we don't know what the future holds for the banks. You won't have to be as concerned of them slashing your credit card without notice. Okay, now most likely they did give notice to these guys because of the certain regulations that are in place as far as notifying the customers, notifying their clients. However, this is something that I want you to look at, and I want you to get a hold of me. Okay, creditwiz@investorpro.org if you have any questions on this. Of course, if you'd love to work with us, we definitely we have an average now of over 30,000% ROI for our clients, and making sure that they get those credit limits and that they keep those credit limits and can use them to pay down the student loans, any kind of loan, because we help them to allocate their money in such a way that they're paying way less in interest than if they would have had a consolidation loan. So, folks, don't forget to like, share, subscribe, and let me know what you think about the slashing of the credit limits. God bless. Have a good night.